Okay, guys, so this is the basic training, module 2, the foundation. I'm going to use a much faster pace and I'm going to be a little bit more strict because this is, after all, a boot camp. So I need you to tell whoever's in your room to get out of the room. If your wife or girlfriend is talking to you, tell her to be quiet and get out of the room. I'm the type of person, if my girl's talking to me during a movie, I pause the movie. I tell her, okay, are you done talking? All right, good. Now resume the movie after you're done talking. That's how I am. Very black and white. I've been trained to think black and white. I'm extremely disciplined. I'm extremely punctual. If I have a meeting with you, if I have a business meeting with you, you show up more than 5 minutes late, I'll never ever see you again, nor will I show up at your funeral. You're dead to me, pretty much. Okay? The Bible says you need to forgive people 77 times. I'd rather find 77 people who are not going to screw me over and waste my time. If I live till age 80, 85, that means I have another 40 million minutes to live. So I don't want you to be wasting my minutes, and I'm not going to waste yours. Okay, so make sure your phone's off and make sure there's no more interruptions. And if you don't understand a single sentence or you cannot understand my pronunciation, please rewind the video or ask in the comment section or shoot me an email. All right, so here we go. The farm, okay, the way stock market works, there are different animals. The main ones are bulls and bears. The bulls, they hit you with their horns and you fly up in the air. Okay, that's why it's called going long. And the bears are the participants who want the stock to go down. They're also known as short sellers. So one way to remember is they hit you with their paws, they bring you down. So bears want to bring the stock market down, the stocks down. So they hit you with their paws, they bring you down. The bulls, they hit you with your horns, you fly up in the air, so they're going long. So from now on, I'm going to be saying long or short. When I say long, you automatically think of me as a bull. When I say short, you automatically think of me as a bear. You can be both at the same time on different stocks, or you can choose to be a bull on Tesla in the morning, and then in the afternoon you might become a bear and short sell it way down. So, contrary to what most will tell you, most professional day traders, they want to be a bear because fear sets in faster than greed. I need you to repeat that several times so it sticks in your head. Fear sets in faster than greed because stocks fall much faster than they rise. Okay, a stock can fall 5-10% within a few seconds, and then it might take a couple of days to recover the same amount. Moving on. So again, bulls are going long, bears are going short, short selling, the shorts. So when you hear these terms on CNBC, you already know what they are. Now, there's also other animals, and you see at the bottom it says pigs. The pigs, they take too much risk. You know, when they say you're being a pig, that means you also have a lot of profits that you haven't taken off the table. So if your option goes up 100% and you still haven't sold it, you're being a pig, you're being a hog, you know, and pigs get slaughtered. So don't get too greedy. Take profits when it's time to take profits. And the more you trade, the more you'll understand exactly when to take profits and how much to take it at certain times. Sometimes it's best to let it run higher. Sometimes it's best to take half off the table or 25% off or 1/3 or what have you. Then we got the sheeps. Okay, they hardly take risks and they stay broke. You know, they're scared of losing their money, so they stick to CDs and treasuries, which barely make any percentage gains. So I'd say a lot of older conservative people, they're sheeps. They stick to low risk mutual funds or bonds because, let's be honest, they don't have a lot of time on this planet left, so they cannot work and make up the losses. Whereas if you're a young guy, you might only trade options because you're going to make it back tomorrow. Next. So why is there a bull statue on Wall Street and not a bear? Main reason because companies need to grow their earnings, right? And they need to expand their operations. So because of that, long-term companies need to rise. The stocks need to rise, more people will buy the shares, and the stocks will not fall unless the company is a lot, has a lot of debt, or maybe they're not making as much revenue, or the consumer sentiment has changed, so their competition is killing them. But essentially, we want the stocks to go higher. And most of these pension funds, financial institutions, they like to hold stocks long term because also there are major uh, tax advantages of holding a stock more than a year rather than being speculative and short selling, taking profits in less than a year. Now, when you sell a stock less than a year, you are prone to capital gains taxes. Now, um, even though short selling, being a bear, is the bread and butter of any professional momentum day trader, you're still not going to see a bear statue in front of Wall Street because Wall Street, since the time of its inception, I think in the late 1800s, they've pretty much wanted major investments, long-term investments in companies, so the companies will have time to grow. Now, but the major pro of short selling is when a stock falls, it falls fast, and you make your money fast, and you get out, you cover quicker. But if you decide that you're going to stay in a stock after it has fallen 50% and now you're going to wait till it goes back up to the same level, you're forgetting one very important concept. The stock for your stock that have lost already, for it to go back to the same level after losing 50%, it needs 100% profit. Okay, mathematically speaking, you can do this. If you look at, let's say, Tesla at the bottom of the screen at $350, you bought it at $350, now it dropped to $175, you lost 50%, right? But in order for you to make your money back up, Tesla needs to rise 100%. So it needs to double to go back to the same figure. And a lot of new traders don't understand this concept, and that's why being long sometimes it's very hard to make money being long if you're a day trader or a swing trader. Now, in the first video I mentioned that the day trading is like considered gambling because of major financial institutions uh, unloading very large orders and which are not seen on level 2. So let me skip forward. I'm going to show you, this is a Bloomberg platform level 2 access. Okay, this is the platform that I got my certification on. So this is showing Apple. This is showing Apple's bid and ask orders. So if you're new to the stock market, let me just quickly tell you that on the left side, we have all the bid orders, and then we have all the ask orders on the right. Right? You see, Apple is trading, let's say, at $439.55, and then you have a bunch of people lined up to buy it at $425, $439 even. So you see where it says size, the column. Okay, when it says 1, 1, 2, 1, 1, you should always add 2 more zeros next to it because that 1 means 100 shares. Someone's waiting to buy 100 shares of Apple at 439.55. So someone's wanting to buy $44,000 worth of Apple. And then you look down, you see that little 10 over there? Next to it, it says market maker WEMM. Okay, so that person wants to buy 1,000 shares of Apple for $439. So he's lined up there, and all these people are lined up to buy Apple at different prices. Once there is a match between the people who are lined up to buy Apple at X price and somebody who's willing to sell Apple at X price, an exchange happens. When the exchange happens, that's a trade. And that trade goes and calculates and adds onto the total volume. And we'll talk about volume later on, but basically every time there's a trade, there's a volume of shares that gets accumulated, and it gets bigger and bigger throughout the trading day. Now, on the right side, we have all the people who are trying to sell Apple. Okay, so let's say one of the meaningful sells is that, do you see the 5 in midway? There's 1, 1, 1, 1, 1. There's a bunch of 1s, and then there's a 4, 1, and a 5. You see that 5? That's 500 shares. Somebody's trying to sell at 440. So again, very relatively similar or order flow, right? But let's say UBS is trying to, um, sorry for a second. So let's say UBS or Citi wants to sell 17 million shares of Apple, okay, or 15 million shares, whatever. A giant order. You actually think he's gonna put a sell order and put a sell order of, let's say, what is it, 100,000? Let's say the size is gonna say 100,000, which means a million. Sorry, 10,000, which will mean a million shares being sold. You think they're going to actually show their large order being placed as a sell or a buy? Once they do that, guys, the people will panic like there's no tomorrow. So if a large institution like UBS or Citi, they put a large order like that, most likely the stock's going to just gap down. It's just going to tank. It's going to sink like at least 5% immediately once they see that kind of a large order that wants to be liquidated. So what they do is they take that order, okay, let's say $15 million shares of Apple, they're going to split it into 15 pieces of million shares. And they're going to give it to their rep at UBS or Citi or what have you. And they're going to say, you know what, layer about million shares in the morning, layer about million shares an hour later, and another one in 30 minutes. Try not to drive the price down too quick and do it nice and smooth so that people don't realize it. And sometimes I've been caught in these beautiful sell-offs that have these little reversals to the upside and then a nice little sell-off. And then one little bit of reversal to the upside and nice little sell-off. Basically, it gives you hope that it's going to reverse, and then nope, it brings you down again and again, and just like a slippery slope down like 5-10%, whatever. So this is, the market makers, they do a very good job of not creating panic immediately so that they can unload it at higher prices. So again, you're not going to see these major orders. They're set as invisible and they have level 3 access. You're not going to have level 3 access. You're only going to have level 2 access, which is what I just showed. They call it tape reading, basically, ticker tape reading, where you have your order flow, where you think that's all there is, but there's a huge dark market. I'm going to say it's called dark pools and fractional trading that happens before you see those prices. So even though you see, let's say, Apple at $439.55, that 55 cents goes into the dark pool and gets sliced and diced between different hedge funds and becomes 55 cents and 1/4, 55 cents and 1/18, 1/16 and 1/8. And then they give you the worst possible price, but you're thinking you're getting the best price, even though it's a whole cent that you're seeing, where there was a fractional trading that occurred in a dark pool. And there's videos that on YouTube that you can watch about fractional trading and so forth. So again, when a major institution wants to unload their shares, your technical analysis pattern can get erased like that, like an Etch-a-Sketch. Okay, so imagine you took this large bet on an intraday basis while day trading, all of a sudden, boom, opposite happens. So you have two choices. One, you're going to buy more, and two, you're going to take your losses and move on to another stock, or you're going to try to short it, you're going to go reverse. After taking a series of these small losses over and over, if let's say you have bad series of trades, let's say 5 to 10 trades, I guarantee you it's going to shatter your confidence and you're going to get scared, you're going to take less risk. And once you take less risk, that means it's going to take you longer to recoup the losses that you have already made. And this is what beginner traders actually go through. Okay. We did this, we're moving forward. And one thing I want to mention is the market makers will play these games. They'll trick you. They know exactly how much risk you're willing to stomach because your broker sells your information to them. Yeah, this is legal. And the lingo, when they say they try to push out the weak hands, the weak hands are the ones that have taken more risk and they've tapped into their margin account fully. and that's why they're not able to. They get panicked. They get panicked because they don't have any more money that they can borrow. And they're worried, wow, I'm going to lose a lot of this margin money, so let me take my losses. Once you take your losses because of that, and other people do the same thing, well, guess what just happened? The stock fell even more. And it just creates this slippery slope. All right, again, day trading is like running through a field full of mines. I'm sorry I didn't have a good picture here, but I chose the one of the mouse with all these traps. They call them bear traps, they call them bull traps. Bear trap if you're a short seller, and a bull trap if you're long. So forget this mouse picture for a second. I'm going to use my mines analogy. Let's say there's a field full of mines, okay? And basically, day trading is you running from one side of the field to the other, knowing there are landmines, and you're hoping not to get blown off. Okay? I guarantee you're going to get lucky here and there, and you're going to hit major home runs. So that doesn't mean it's going to happen consistently. So once in a while, you're going to step on these mines, and you're going to blow your leg off. So you're going to take a major step back in your profits because you got tricked by a market maker or an algo software, especially if you're trading a lot. So because of this, most day traders, they trade the first hour. Most of it happens in the first hour, and then a little bit during lunchtime in New York, and a little bit of position closing at the last 15 minutes of the close. But the majority of the trading happens in the first hour because there's a lot of volume and you're not susceptible to algo softwares manipulating you. So again, you're going to get lucky here and there, but once in a while you're going to take a major giant step forward. And then, so you can subtract those losses from your gains. You can subtract your capital gains taxes. You can subtract the money you're going to withdraw every month to pay your bills, travel, expenses, and then you can call yourself a professional trader. So if this is your only income from your day trading capital, you're withdrawing and you're constantly, do you know how stressful it becomes? Do you have any idea how cheap you become, how frugal you become, just so that you can stretch your dollar to the next month? And what happens is you start stressing more. You're like, okay, I cannot take this heavy bet, even though I want to. I cannot take this heavy bet because I'm afraid I'm not going to be able to pay my car payment. You know, this is ridiculous. You know, so if you don't have a sizable capital versus your relative monthly expenses, then it's really tough, guys, and it's really tough on your emotions. So don't believe anybody that says that they're professional traders. Most likely they have some real estate income coming in or something. There's a Saudi Arabian guy on Instagram. He's flooded with cash and he's flying around acting like he's a professional trader. He's hiding all of his losses and he's only showing the gains, and people are buying into this, and most of his students are not even making decent profits. So beware of that. You know, these guys will show you their biggest gains and they'll show you the smallest losses. Okay, that's another thing to watch out for. So let's talk about the market. When we talk about the market, we're mostly talking about the S&P 500, but there are three distinct indices, plural: Dow Jones, NASDAQ, and S&P 500. So from now on, when you listen to CNBC or Bloomberg, they're going to talk about these three major indexes. I should say indices, but it doesn't sound right. So I say indexes, even though it's indices, the correct way. So Dow Jones, I'm sure you've all heard of it, is basically the 30 of the largest U.S. public companies, guys. They employ at least 5% of the U.S. population, and they have about $6-7 trillion of cumulative market cap. So high-priced stocks like Boeing, McDonald's have larger moves. They're components of Dow. Now in Dow, one thing you have to remember is the stocks that have higher share prices, they're given greater weight in the index. Okay, that's one thing you should remember about Dow Jones. You're always going to look at Dow on the side, and you're going to look at it and say, okay, these house the 30 of the biggest companies of US. Okay, AT&T is another one, Caterpillar is another one. But the ones that have the highest price, they have the largest moves, and well, not necessarily. They have the highest price, and they're given a greater weight in the index of the entire average. So basically, you take the average closing prices, you divide it by 30, and that's how Dow Jones average is calculated. So then when you hear the word market, they're talking about the S&P 500, Standard & Poor 500. It has a much more diversified mix of companies, and there's more companies. There's 500 versus 30 for Dow Jones. So of course, 500 companies, they give you a more better reflection of the entire economy, right? Versus 30 bigger companies. And 500 mid-cap companies, large cap combination of mid and large cap companies, to me, is a better indication of the economy's health versus 30 large companies, very large companies. They call them mega cap companies. So, but in S&P 500, what makes S&P 500 stands out is that it is based on market cap. Okay, so stocks like Facebook has a $500 billion market cap. Honeywell has 125 billion market cap. So the stocks that have a larger market cap have more weight. So Dow Jones, whoever has the highest price is given more weight. In S&P 500, whoever has the most market cap, meaning size, whoever has the largest size is given more weight on the entire index. So let's when I have a definition side, like I'll put it in red. So my slides will have a red vocabulary side, or if I have a rule, it'll be highlighted in red. If I have a tip, it's highlighted in yellow. So at the bottom, I have the vocabulary section. This is where I talk about market cap. When you hear the word market capitalization, short market cap, that formula equals outstanding shares times stock price. Each stock has an outstanding shares. So when a company goes public, they decide how many shares they're going to issue. The more shares you issue, the more you're liquidating your company, right? If I take a pie and I slice it into 16 parts, and I say, okay, all of us are going to buy one pie of this, you're going to say, okay, we all each 1/16 of the pie. But if I have a pie and I slice it into 4 parts, and I only have 4 investors, of course we're going to feel better about ourselves because we own a bigger chunk of the pie, right? So the companies that have larger outstanding shares, they're more diluted. You know, I don't feel good when I have 50 shares of Apple. Even though 50 shares of Apple is thousands of dollars, I'm still buying 50 shares of Apple of, I think, I don't know, almost a couple of 100 million shares outstanding. So, you know, stocks that have a smaller outstanding shares, they're way more volatile than stocks that have larger outstanding shares. And it makes sense, right? If you have smaller outstanding shares, then few large players can manipulate the stock. You know, if few large funds buy a huge chunk of that company, for example, when Oprah bought the Weight Watchers, Oprah's investment in Weight Watchers, I think, surged the stock like 10%. That was insane. And she benefited from that because she took a huge position in a small company in a sense. So one thing you should know about market cap is every day its size changes. So tomorrow you can wake up and see Apple's market cap is going to be way different than the week after and the week after. So a few months ago, Apple finally hit $1 trillion market cap, and then it went down, right? And then I think Microsoft surpassed them, the 1 trillion. And then I remember at one point, Apple and ExxonMobil were battling who's going to have $1 trillion market cap. So the market cap always changes because the stock price changes, not the outstanding shares. Got it? So market cap equals outstanding shares times stock price. The stock price changes every day. Outstanding shares stays constant. Got it? So don't confuse outstanding shares with float or enterprise value. Okay? Accounting value, enterprise value, book value, float. We're going to talk about that stuff later. But right now, just understand what the market cap definition is. Then we got the NASDAQ, which stands for National Association of Securities Dealers Automated Quotations. If you didn't know about it, then now you know. You can impress your friends with that definition. So this was an index of more than 3,000 stocks listed and includes the world's technology. Major tech companies, they're housed under NASDAQ, okay? Like Apple, Google, Microsoft, Oracle, Amazon, and Intel. The stocks that have four letters, okay, when the stock symbol has four letters, most likely it's under NASDAQ. So this was the world's first electronic exchange and operated in 25 markets, and it has one clearinghouse and has 5 central security depositories in the US and Europe. So NASDAQ was a game changer because it was all automated, and it brought a huge difference. We have the ETFs that are NASDAQ based, like the QQQ. When I trade the top 100 companies, I traded by buying QQQ, and you should always add this to your watch list. So again, you're gonna add Dow Jones, you're gonna add S&P 500, you're gonna add NASDAQ. The stock symbols are DIA. You're gonna add QQQ, which is for NASDAQ. Then you're gonna add SPY for S&P 500. And for now, that's all you need to worry about. Add those 3 exchange traded funds, and don't worry about what exchange traded funds are right now. Add those 3 ETFs, which mimic these indexes that I just mentioned. But when you open any broker, you automatically gonna have a preset of those 3 indices: Dow Jones, S&P 500, and NASDAQ. All right, so then we got also Russell 2000, but again, as a beginner, I don't want to give you information overload, but note that there's also another index called Russell 2000. Russell 2000 tracks the small caps. So all the junk small cap stocks, the bottom 2000 stocks, there's an index for it, which is Russell 2000. Okay, so one thing I can tell you is during major crashes, major recessions, Russell 2000 tanks. So you need to buy Russell 2000 when they're very oversold, and this happens at the height of a recession. And it's intuitive, right? The companies that don't have a lot of power, they don't have a lot of cash on their balance sheet, they're small, they're gonna get destroyed during recession, and they're gonna be susceptible for a bigger company to buy them out. So you want to focus on Russell 2000 when recession is at its peak and we're about to recover from a recession. Whether it's a V-shaped recovery or a bathtub shaped recovery, you want to start keeping an eye on Russell 2000 when that happens. If you're an investor. If you're a day trader, a trader, again, that's a whole different topic. So, a very important rule, okay? Make sure you always keep your eye on Dow, S&P 500, and NASDAQ throughout the entire day and for the rest of your life, okay? I want you to make it a habit every morning. You're supposed to look at Dow, S&P 500, and NASDAQ indexes and their futures. You need to understand what goes on with them when we're sleeping, how the Asian markets are behaving, what's going on with them before we wake up. So it's all connected, guys. You always have to keep your eye on this, and the stock market is connected to the equities market is connected to the bond market, the fixed income market, the real estate, and the market acts as a leading indicator of being 6 months ahead of the real estate. So if you see the stock market have 2 consecutive quarters of negative growth, that means most likely real estate is going to dip very soon. Okay, so a lot of real estate investors don't even understand this part. like they don't even look at the stock market that to gauge it as an indicator, because when the fixed income 30-year rate changes, that gives you an idea whether we're going to have higher interest rates in real estate or lower interest rates. So you can kind of gauge to see how many quarters of negative growth we have and how it's going to possibly push real estate into a recession. And that'll give you an indication to whether sell your house or uh, stay on the sidelines and maybe not buy that purchase yet. Until, anytime you buy real estate, you should wait until a major real estate crash occurs. And honestly, what I love about the stock market is every day you have these mini crashes that happen in different stocks, and you're constantly looking for discounts, just like you're looking for a discount in real estate. Market works the same way. So another thing I should mention about the three indices is they might diverge here and there. Like maybe the Nasdaq might do its own thing because of Huawei recently with the China tariffs, and the tech stocks got crushed. So maybe QQQ and the Nasdaq might take a huge hit and kind of diverge from S&P 500 and Dow. But best believe that later on they're going to start trading in parallel fashion. So they diverge here and there, but if you look at the overall several years chart, you're going to see a very nice, smooth parallel fashion of trading between the three indices. One tip I should give you is if your stock, let's say you're in a stock and this stock is surging higher in price, and you're up a great amount, you made a killing, and you don't want to take profits because you think the stock's going to go higher and higher. If all the market indexes reverse and start going down because of a news event or what have you, you might consider taking some profits, because most likely the index that your stock is housed in, that index sell-off is going to bring down your specific stocks. So oftentimes you're going to see stock bullish pockets in different stocks because of earnings or company-specific news event, and it's surging your specific stock higher. What I like about Tesla is Tesla sometimes doesn't care what the overall market does. And Nasdaq has to be really in a bad condition to bring Tesla down. Tesla does its own thing. I also noticed this about restaurant sector. Certain stocks, not all stocks, like Jack in a Box, Shake Shack. Some of these stocks they do their own thing. Denny's, Wendy's, Starbucks, not so much. Starbucks, McDonald's, they kind of follow. Although Starbucks, it depends on the day, but McDonald's usually, yeah, definitely follows Dow. So you'll notice that each stock has its own personality. They are so different from one another. They trade very differently. Once you follow them many years, and you'll see that a major pattern that was working for 6 months might stop working later and might work again later on. So you'll notice that as you take these stocks under your watch list and you watch them for a while, you're going to see their own behavior, you're going to see their own personalities. For example, I don't trade Google at all. I got crushed on Google at least 4 times, and it's very boring and stock to trade, but as an investment, it's a great investment. But as a trading stock, Google is garbage. Like, I won't even touch it. I don't even care about it. I just keep it on my tech side just to see what it does. But yeah, so you're going to find stocks that you're just not going to like, period. All right, so let's talk about the key market players, guys. The key market players in trading is financial institutions. These are the major, players. As a matter of fact, when you start looking at stocks descriptions and what they do, how much their fundamental side, you're gonna see it's best for you to check the financial institutions percentage. Okay, if it has a high financial institution percentage, that's a good thing in my book, because I like the fact that A lot of large financial firms are actually have confidence in the company, versus uh, major insider percentage. Sometimes there's low financial institutions percentage ownership, but there's a large company insider ownership. So even though there's not a lot of confidence from outside firms, the CEO or the board members, the executives, they own a large chunk of the company. So you decide whether this is a good thing or a bad thing, depending on a sector, depending on the products that they sell. This is I cannot generalize it, over all stocks, because from one sector to another, this might be a good thing or a bad thing. There's also pension funds. Pension funds usually buy companies for longer term, until, insurance companies also, like, they buy long term because they only keep a very small percentage of money in very, what's the word? Liquid assets, so that they can tap into it to make their insurance payouts. They have a very small percentage of money that they need to pay for accidents, death, and so forth. So they know majority of our money is fine. We can hold long term, but a small percentage of our funds, we need to pay out these insurance claims. Then we got the hedge funds, right? Hedge funds is kind of what I do. I hedge my positions and I keep a portfolio of long-term stocks. Proprietary trading firms, these are the guys that trade very actively, high frequency trading and so forth. Sovereign wealth funds, very rich individuals from Saudi Arabia and so forth, Middle East and other China and so forth. Then we got the retail traders, which is guys like you and I, right? We're retail traders. And Obama. I wrote this just to piss off all my conservative friends. I like to have fun sometimes. So I have a lot of conservative friends from Texas. When you say Obama, they just get the chills. So I put that to annoy every conservative person who's going to watch this video. Anyway, so do you want to learn swing trading or day trading first? Let me answer that for you. You need to learn swing trading first. As a beginner, don't even think about day trading first, okay? You start off swing trading. Swing trading has a way lower risk, and it's way better on your emotions than day trading. So you can start off swing trading, and whatever profit you make on swing trading, you can open a separate account with day trading, and you can transfer that profit to your day trading account and do your day trading over there. If you lose money, then you come back to swing trading, you make money in your swing trading account, then use that profit to put in a day trading account. And this is a very prudent way of approaching this. Unless you're making a lot of money in your company, then you can be like, okay, I'm gonna put like $10,000 in my day trading account, and I'll keep another $50,000 in my swing trading account, and I'm gonna try both. So you be the judge, but I'm just telling you, as a disciplined trader, that's what you're supposed to do. Okay, so swing trading, aka position trading, you might hear that term as well. It means that you're holding a stock for more than a day. Okay, once you hold it more than a day, maybe a couple of weeks, couple of months, sometimes up to 6 months, you're a swing trader. You're trying to ride the trend, and you're trying to get off at the peak once the stock starts sinking. So the stock will make higher lows, higher highs, and then at the peak, the plateau, you want to get out. And that's swing trading. So it has a higher consistency of profits, but it has lower returns. So which means you will be right many times more than day trading. So a lot of your trades will be definitely profitable because you're going to wait out all the losses until it becomes a gain, but you're going to make less returns than day trading. So with swing trading, you're looking to make between 20 to 60% a year. Okay, that's the range basically. And after you take my course, you should hit between those ranges. Okay, but the better you get, you'll hit up to 50, 60% a year. If you trade options, then definitely you might push that to triple digits, okay? But I'm talking about stocks right now. Day trading means you sell all of your positions the same day and become 100% cash by EOD. When you hear the word EOD, that means end of day, okay? So you're 100% cash by end of today. You're going to sell everything you have. So when you hear somebody say, I'm a day trader, day trading, they're talking about buying and selling stocks and make sure they sell everything by the end of today. Or sometimes they hold a very small amount of stock for the next day, but it's nothing major. Okay, it's nothing that they're gonna lose sleep over. Day traders' main advantage is they want to go to sleep not worrying about the next day. Every day it's a fresh day. But the major con is, if let's say I have Apple today and Apple earnings come out tomorrow before market open and Apple gaps up at the open, well, guess what? The day trader missed that move. But also the opposite could happen. If I have Apple today and tomorrow I keep it overnight and tomorrow morning Apple misses earnings, Apple gaps down 4 or 5%, well, I just lost, and the day trader is like, oh, great, I get to buy Apple cheaper because I know it's going to go up. So day trading has its pros and it has its cons. Now, with day trading, you're trying to shoot for higher returns. You should be making at least 60% a year, up to 500% or more. Again, if you trade options, if you combine options into your trading strategy, you can push this to 1,000%, 10 times the money. You should be compounding your capital 10 times over. It's possible. In 2010, I made close to 700%. So it's definitely possible. But again, the way I made close to 700% was I was scalping small profits over and over and over. Okay, again, that method is done. It's history. You can only do that within the first hour maybe, and then Algos will eat you alive. Algorithm-based softwares that trade in nanoseconds, they'll manipulate you, they'll take your money away. You cannot do it the same way. So the returns are a little bit more reduced because you're not able to use that strategy throughout the entire day. Now you can only do it about an hour, and then you need to close the computer and go back and do something else and come back when there's lunchtime in New York and see what happens to the volatility. So now the next thing is investing in portfolio management. So investing, guys, is the easiest thing in the world. Okay, monkeys can do investing. So if you tie your eyes and just pick any company from Dow Jones, if you pick AT&T or I don't know, Chevron, Home Depot, pick one. You buy it and you hold it a year, 2 years, you're going to make money. If you buy Walmart, I guarantee you're going to make money because Walmart stock is going to rise over time. They're going to do a stock split and it's going to rise again. So you will make money consistently, definitely. But in a bull market, number one, and number two, you're going to be making maybe 10-20% a year, okay? Depending on the stock you buy, maybe if you buy a growth stock like Apple, possibly more. If you buy a dividend stocks don't grow as fast, so less. You might buy a combination of both. Older people, they like to buy utility companies because utility companies and REITs also, REITs are real estate investment trusts. If you buy utility companies and REITs, they usually pay a higher dividend payout, but they don't grow at all. So a lot of guys like Kevin O'Leary from Shark Tank, he says that he wants to basically, he doesn't care about capital appreciation. He doesn't care how much the stock rises. He cares about how much money you're going to give me every quarter. How much dividend are you going to pay me out? Verizon pays what, almost 4% dividend. So a lot of these companies, they pay hefty dividends, and some people don't care about how high the stock rises as long as you keep paying me that dividend. Another good dividend payer is Las Vegas Sands, Chevron. These are good ones. So again, when you're investing, you're going to make way less money. Unless you have $1 million, that return you're going to generate from investing is not going to be enough for you to live off of. Okay, so that's why when you're a small fish in the pond, you're trying to take more risk, whether options or small cap stocks. Day trading, people do this to get to a higher capital size so they can take less risk. Okay, so that's the name of the game. I always tell people the richer you get, the less risk you should take. Logically, that makes sense because you're trying to preserve your capital and you're shying away from risky speculations, right? So, okay, so then I'll talk to you in other slides of the difference between investing and portfolio management. So, a few rules, okay? Remember this, please remember this. Day trading, swing trading, and investing have their own specific, unique rules. You have to follow them and abide by them, and they drastically differ from one another. Day trading is a completely separate beast. Swing trading is a completely separate beast. Investing / portfolio management is a whole different world that you don't even know about. I can talk to you about the weighted average cost of capital, Sharpe ratio, discount cash flow analysis, all the stuff I learned in my finance classes, all the stuff when I was teaching in my courses. People were like, you're giving me a headache. What the hell are you talking about? So you need to know about finance if you're going to go into the portfolio management side. Otherwise, you want to just go look at swing trading, technical analysis, then you're just a day trader or a swing trader. But my method combines swing trading. My swing trading method combines technical analysis with some fundamental analysis. Okay? My swing trading method, for me to gauge my initial entry size, I need to calculate the discount cash flow analysis, which means what gives me an intrinsic value of a stock. I need to know what's the book value of the stock. I need to know, and granted, not too many people can, some people might argue nobody can calculate the actual intrinsic value. And this is because of efficient market theory. All you finance nerds know this. But I have my own model that I use with my Excel spreadsheet of calculating the discount cash flow analysis and finding out what the stock price should be today, or close to it. I calculate that, I can kind of gauge it and say, okay, is it trading higher than that, or is it trading lower than that? What's the worst case possible standard deviation that I can have if I get into this stock? And as it goes down close to my intrinsic value, how much more can I bet? Okay, so my swing trading method, my slingshot strategy, and my two parachute system is revolutionary. And I don't share it with anybody until you take my course. And that's why I created this. So, again, you must keep your swing and day trading accounts separate for at least a year until you get more experience. So when you're starting out, I want you to open a broker. One broker is going to be just for swing trading, and then I want you to open another broker that's going to be just for day trading. And I don't want you to mix these two accounts together until you gain at least a year of experience. For some of you smart cookies, maybe 6 months, but at least a year. Because combining those three methods together and trading in one account, it takes a special person. So there's just so much math involved in that. All right, so, and then one tip that I should give you is, again, you should learn swing trading first and only use your profits from swing trading to learn day trading. Always play with the house's money. Now, people are going to wonder, what is my trading strategy? I have several accounts. I have different accounts, but my average daily trades, I would divide it into these parts. 50% of my trades, adjusting positions, closing, hedging. 50% of my trades are in the portfolio management side. I do swing trading about 3% of the time, 30% of the time. And when I do swing trading, it's again stocks, ETFs, and options. So is my portfolio management. But But when I do day trading, it's mostly stocks and ETFs. Okay, I hardly day trade options. Although I did about a couple of weeks ago, I bought XLE. XLE was so oversold. I went heavy into XLE options and I dumped it literally within 2 hours. So doesn't happen often, but once in a while I'll day trade options. When I was starting out, guys, when I was in college, I was day trading FAS and FAZ options, weekly options. Do you understand how much risk that is? Let me give you an example. FAS trades 300% more volatile than XLF. So I was trading the options of something that was already 300% more volatile. Plus, it's a type of an index that you don't hold overnight. These things get reset every night. So I was taking so much risk without really understanding. And I see these same people in these Facebook groups. They're starting out by selling calls and puts, not even understanding how options work, number one, but not even having experience in trading stocks. They're starting at the most riskiest assets, and they're not even buying the most risky assets. They're selling or selling the calls and the puts. When you sell a call and a put, you have the obligation to deliver. If a trade goes against you and you don't have the capital to back it up, you just screwed your brokerage account, you're going to get a margin call, and you might even screw your credit up. So you got to be very careful in selling options, guys. Unless you have the 100 shares of stock to back it up and your calls are covered and so forth. So again, as your funds grows, you should take less risk and gravitate towards portfolio management to protect your profits. Warren Buffett doesn't give a damn about technical analysis, guys, okay? Technical analysis to him is just noise between one quarter to another. Okay, that's all it is. It's just noise. But here's how much money Warren Buffett has. He doesn't even care about from one quarter to the next. I mean, when I'm looking long-term stuff, I'm going and reading the quarterly reports. He just reads the annual reports. He has a horizon of 5 years down the road, 10 years down the road. He doesn't even care what happens from one quarter to the next. Now, that's the type of investments he's making. That's my dream, is to get to that level. Okay? It's very fascinating. Technical analysis is just noise, guys. A lot of swing traders out there, they don't care about day-to-day, intraday. They look at longer-term trends of weeks, months. They're looking at the longer-term trends, and they use technical analysis that way. Major crossovers, right? Golden crossovers, bullish, dojis. There's all types of haramis. There's all types of longer-term technical analysis patterns that we're going to learn later on. So again, every person on this planet that trades on the market is categorized in these three trading styles. Up to year 2011, 2012, there was a lot more day traders than are now. There's a lot more. Okay, again, hedge funds started taking these algo softwares, using quants, they call them quants, to write these softwares. And when these quants started writing these softwares, they have these if-then scenarios. They'll say, okay, if the retail trader does this, then our software is going to do this. And if a stock reverses and does this, then we're going to take this much risk. If it continues to fall, then so they had every probability listed in the algo software, and they run this software. What I would do, I would try to trick the softwares. I knew on smaller stocks, I knew exactly how to trick the robots, basically. I'm going to call them robots, okay? For example, I would, on a small dead stock, okay, it doesn't have a lot of volume, there's not much activity. Let's say I would place a large order that I'm not going to commit to, okay? Let's say I'm gonna put a buy order of XYZ thousand shares. I'm putting in $150,000 buy order. Boom. And I'm saying if the stock drops at, let's say, $25.16, I'm going to buy 150,000 of this stock, even though the stock is trading at 25.50. So all of a sudden, to meet my limit order, the market breaker will slowly bring down the stock on purpose to try to take my money, to take my buy order. Of course he wants to fill my buy order. He's being greedy. Such a buy order on a dead stock. He's like, okay, we have a real buyer. As soon as he goes to my buy order to complete my buy order, I cancel my stock, I get out, or I'll reduce it 90% and I'll raise my order to catch his lower price, and all of a sudden the stock will go back up to the original price. This was, I basically lured him to lower his price. And I can tell you a dozen different ways to try to trick algos on small cap stocks that have very low volume. And this used to work before 2012, again, a lot. And after 2012, not so much. And now I feel as if the algos are starting to be tweaked more. So basically, guys like me try to manipulate algo systems, right? And all of a sudden, let's say if a fund, a proprietary trading firm, is losing a lot of money to guys like us, they're going to call their quant and say, okay, we need to rewrite this algo software, or we need to tweak it a little bit. If he does this, we want you to do this. So basically, it's a chess game of understanding 4 or 5 steps down the road of what he wants to do, and you're trying to do the opposite, or you're trying to trick him. Okay, so me being a chess player, that's what I love. Hey, if you want to try to outsmart me, I'm going to start to think, how are you trying to think? How are you trying to think? I'm going to try to think against that move. Okay? Again, in my upper courses, my day trading courses, I'll talk more about how to trick algos and how they like to think and how they operate and how most algos are written. Okay, again, it's just the if-then scenario, and at the end of the day, they're written by human guys. I don't care if they're math PhDs. I'm good at math too. Just because I don't have a PhD doesn't mean I don't know how he's thinking. There's only several variations that you can do with numbers. It's very black and white. And yeah, anyway, I don't want to get too sidetracked, but I want to keep this as short as possible. How many minutes have I been talking? Holy shit, it's been an hour. Fuck. Alright. This is much longer than my first episode. Okay, which is good. It's a lot of content for you guys. So, what's the difference between investing and portfolio management? I keep talking about it. So, as soon as you invest in more than one stock for more than a day while having both positions open at the same time, then you just entered the world of portfolio management. Okay? Once you have more than one stock open, and there's a lot of investors out there, they're like, oh yeah, I'm holding a little bit of Chevron, I'm holding a little bit of Walmart, long term. Well, guess what? They're supposed to know portfolio management. Otherwise, they're like, okay, my one stock might go down, my another stock goes up. So when you have a basket of stocks open at the same time, then of course they're not going to all trade the same way. They're not all going to go up at the same time. Yeah, if it's a very bullish day, yeah, they're all going to go up at the same time. But they're in a diversified fashion. If one of them is a tech stock, one of them is a oil stock, one of them is a healthcare. Just like Jim Cramer has the Mad Money show, he has the Am I Diversified section. This is what he's trying to do. He's trying to help people get more diversified, but he's not going to help them in a sense of basically making sure that their overall yield is high. It's very complex. That's a very complex thing to do, to make sure that all of your stocks together end up in a positive territory at the end of each month. Okay, And this is why portfolio management is one of the most complex things in the world. And if you're a hedge fund manager managing a lot of money, if you do 30% a year, all the fund manager will steal you away. So yeah, you can make 50% a year on $1 million portfolio, but when you have $100 million portfolio, $500 million portfolio, that 50% a year is very hard because now you have to diversify into fixed income, bonds, you need to hedge yourself, you need to put some money in currencies, you need to hedge against the dollar. So there's all these things that add up. So again, my passion as a day trader, although I'm a day trader, I started off as a day trader, my passion remains in portfolio management because eventually, if I have people shoving money down my throat into my company, I just became a portfolio manager. So I'm not going to go back to day trading because once your money rises, hopefully it's going to stay the same, increase higher. I'm not going back to day trading, high frequency trading days. Although I do enjoy it. I've been playing video games my whole life. I don't know if I mentioned this, but I played Lord of the Rings every day for the last 10 years on the old Xbox. This game is one of the best games for any trader, any stock trader. You need to play Lord of the Rings, and you have to get to my level. I play against 3 brutal computers. Brutal, not hard, not very hard, not medium, not easy, brutal, and I win. Okay, so when you play against brutal computers, simulators in a skirmish mode, you don't understand how much your pressure, strategy, and handling of finances is tested. By the time you finish one game, your brain is drained. Okay? So I suggest you play this game, start from easy and then increase to medium competitors and so forth. Go to hard and brutal. So let's see, I think I covered everything on this slide. Again, a day trading skill becomes useless over $10 million. Guys, once you go over $10 million, you're not going to bet $10 million into one trade. That's stupid. Okay? So when your money grows to meaningful heights, then you're forced to take overnight positions. You're forced to buy dividend stocks. You're forced to get into fixed income markets when you reach $50 million. You just have to diversify. Otherwise, you're going to take one major risk and you're going to get destroyed. There's videos you can watch on YouTube of these guys that made a killing in the Forex market. And when the Asian crisis happened, they lost almost everything. And they're now so scared that they're not going back to trading because they took these are multimillionaire guys that became so overconfident and they took too much risk in one security. This is what I'm trying to say is this is the real core of greed and stupidity, because when you become successful, you stop learning. Okay? When you have series of successful trades, you become overconfident. As soon as you become overconfident, the market will get you. Yeah, and that's how the market works. You'll get caught slipping. Believe me when I tell you. You'll get caught slipping. When you become overconfident, that's because you've had a lot of success. And it's the human error. It's the worst thing. And for some people, it's worse than others. It's very hard to stay humble when you're making disgusting amount of money. And when you watch some of these videos of these guys that lost all this money, their confidence is destroyed. If they're trading, then they're trading at a very low level now. Okay? So yeah, that's what I want to... Don't get caught slipping, guys. Don't get caught slipping. Okay? The market will get you. All right. Last slide. I always have a quote I like to say. exactly an hour, right? Hour and 5 minutes. Last quote, guys, by Mike Rawlings. It says, "It may get better before it gets worse, but it will get better." BS. I have my own version of this. Mike Rawlings' quote has nothing to do with trading. He's talking about real life. In trading, it may get better before it gets worse, and I striked out, but it will get better. It might not get better. Okay, I'm a very realist. I like it when movies sometimes have a bad ending. Okay, because it's a more. I don't like to spread false hope. Sometimes things end bad. Okay, uh, so I have another version. It may get worse before it gets better. So you never know. If you're in a crappy company that's about to go bankrupt, if you're in Sears, and back in my day, Sears was a giant. Sears is too big to fail. Sears is gonna make a comeback. That's all in your head. Okay? You need to follow the majority. You need to look at the news and see that, oh my God, Sears just hired bankruptcy lawyers to do reorganization. So just because you have high hopes of a company doesn't mean it's going to turn around. Okay? And people who believe in God, people who truly believe, have faith, and faith gives me confidence and all this stuff, I think you should stick to investing, not day trading. Day trading is about killing your enemy before it kills you. Okay? Investing, stick to like large cap companies that have a lot of money on their balance sheets, and that way you don't have to worry about stuff like this. But having false sense of hope and faith will get your account blown out. Don't ever do that. Okay? People who believe in God, they're wired differently. I'm a realist, and as a realist and a futurist, I'm always labeled as a pessimist. I'm not a pessimist. I just know better how the world works. Okay? I believe in the Schrodinger's quantum physics theory. I don't believe in stuff I don't see. I don't believe in fairy tales. I don't believe in talking snakes. Okay? So it's very important you understand that um, spiritual people, agnostic people, they tend to do better in day trading rather than um, theists. Okay, guys, that's about it. Now move on to module 3. Move it, move it, move it, move it. Hopefully you guys got a lot of information. I'm really sorry that I told you that I'm going to keep it short and I ended up talking an hour, but I feel very good about this module 2, and I said everything that I needed to say. I think it was very informative, and I want you to keep going through all the modules until you're done with my basic training. Boom! Done.